right, look, the Fed's at war with inflation. And they didn't exactly win the battle with today's Consumer Price Index report at 8:30 this morning. Yep, we got another overheated CPI, not what they wanted, not as bad as last month, but way too elevated. When I talk about the Fed winning or losing the fight against inflation, I mean the fight to tamp down expensive spending, allowing overstretched supply chains to play catch-up, easing some of the strain of the labor market, and, of course, making it so it doesn't cost so much for dinner. So there's at least one front in this war where Jay Powell does keep winning, though. And it's one that you and I don't want to hear. It's one that is absolutely driving us crazy. He's winning the fight against the stock market. Because remember, the stock market is an amazing source of funds to buy things, raise kids, retire with them, take vacations, and it's all being obliterated right before our eyes. Once again, the Dow lost another 327 points. S&P tumbled 1.65%, but the Nasdaq plunged 3.18%. And that is one of the more quiet but devastating bear sessions in recent history. It just kept dripping and dripping and dripping. Plus, we had more large-cap disappointments just this evening. It's not letting up, and it is, as the late Jackie Gleason would say, a revolting development. And these are just the big averages. It's even more obvious when you look at the collapse of the IPO market and see the stocks in the Russell 1000, which contains the 1,000 largest publicly traded companies in America. Within that index, we're witnessing the most extreme wealth destruction that we've seen since the dot-com bust in 2000, or maybe in 2008, 2009. I want to put this moment in perspective. So I asked CNBC's amazing statistician, Gina Francola, to come up with a list of the worst performers in the Russell 1000 since the Fed took away the punch bowl, and that was done last November. Now, some of these have gotten so small that I normally hesitate to mention them on air, but I think it's important to highlight them because I want you to get the complete picture. So let's start out with the biggest loser, and that's a company called Carvana, the digital used car retailer. For years, I loved Carvana's business model until it got too expensive. I told them you had to sell it last summer. Good call. Carvana had already come down to 284 last November. Now it's at 30 after doing a giant secondary offering at 80 not long ago, just enough to raise money to stay in business. This 89% decline is now accompanied by the layoffs, as we learned today, of 2,500 people. Get used to hearing these kinds of numbers, people. I think they'll loom much larger after the Fed's next rate hike or two.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.